Hello everyone, my name is Anjani Kumar Khetan. In the first technical video for this newly launched YouTube channel, we will deliberate upon one of the pressing accounting issue which most of the preparers of financial statements are today grappling with. This relates to how to disclose material accounting policies. We will also see how one determines whether the accounting policy for a particular entity is material, right? So this is what we will try to see in this particular video. Just to set the context, you might be aware that in February 2021, the International Accounting Standard Board, the IASB, has amended IAS 1, which deals with presentation of financial statements, and also updated IFRS practice statement number 2, which deals with making materiality judgments. And because of these amendments, what these amendments require is that now, post-amendment, entities are required to disclose what is called material accounting policies in lieu of significant accounting policies. So, effectively, it means that an entity now, henceforth, will not be required to disclose significant accounting policies. Rather, they will be required to disclose material accounting policies. Now, so let us see what is the position of the standard before and after the amendment. So if you look at on the right hand side of the slide, you will see here is that paragraph 10 of pre-amended IAS 1. The parallel standard for IAS 1 in India is Ind-AS 1, which also deals with presentation of financial statements. So in both the standards, before the amendment was brought in, a complete set of financial statements inter alia required notes to be prepared, and those notes should comprise of significant accounting policies and other explanatory information. And this piece of the requirement after the amendment has been replaced by this material accounting policies. We will see that. So what happens in this case? Because of the fact that the standard required significant accounting policies prior to the amendment, so before this amendment, most entities interpreted this expression, this requirement of significant accounting policies, they interpreted to mean that virtually all accounting policies that an entity applies in the preparation of financial statement is something which they need to disclose. Therefore, entity used to include disclosures in respect of even immaterial accounting policies. So the policies which are not material also they were disclosing. Likewise, if the IFRS literature or the accounting literature did not provide any optionality, which means there are no multiple application or multiple accounting policy which possibly an entity could have chosen, even if that is not the scenario, still the accounting policies you got to be or were being actually disclosed by the entities because they interpreted the significant accounting policy to mean even those policies that need to be disclosed. Also, accounting policy, even if it has not changed during the year, they were also disclosed as part of the significant accounting policy disclosures. Now, what happens after the amendment? Post-amendment, as I said, this requirement has changed. Now, in lieu of the significant accounting policies, the new term which is being brought in paragraph 10 of the amended IAS 1 and the parallel standard, as I said in India, Ind-AS 1. So the language, this is being replaced by material accounting policy information, thereby meaning that post-amendment, an entity is required to disclose in the notes to the financial statement only those accounting policy information which is material to the entity. So that's the change which has come in the accounting standards, the requirement of the standard. Now, $1 million question one may have, okay, what is the difference between material and significant? How one interpret what is material? So therefore, the moot question now is to understand what material is. Let's see the next slide. That gives you an insight in terms of how one defines what is material. So if you look at post-amendment, paragraph 117 of IAS 1 or Ind-AS 1 has amended, and it states, this paragraph 117 gives a guidance that which policy will become material. It says accounting policy information is material if those information, if those policies can reasonably be expected to influence the decision-making process of the primary users of general purpose financial information, which means the policy information coupled with other information which is given in the entity's financial statement. If you read both together, whether those accounting policy, can they reasonably be expected to influence the decision-making process of the primary users of the financial statement? If it does, then those policies are reckoned to be material in the standard as per the guidance given in paragraph 117 of the amended IAS 1. So now the question is why this amendment was brought in the accounting world. Now the key driver is that the amendment basically seeks to ensure that now the entities provide more pointed, more specific and relevant information only. So the entity provides company-specific accounting information rather than giving information which is, let us say, cut, copy, pasted from the literature or the accounting requirement. No. So the requirement is you disclose accounting policies which are material to an entity and applies to the entity in a specific circumstances. And therefore, because of this thought process, entities will need to provide entity-specific accounting policies and not to disclose standard information which is copy-cut pasted from the accounting literature. That is not the intention. So the intention is you provide more pointed, more specific information which applies to you as a company. So in other words, what we say that this particular amendment will require now the entities to disclose how the entity has actually applied the requirements in a particular accounting literature. So if suppose, for example, impairment. Now how the impairment policy has actually been implemented by the entity in its specific circumstance. And when we come to the fag end of this discussion, I will demonstrate to you by way of illustrative disclosure in the financial statements how entity has applied in my example for that impairment related disclosures, right? So the moot point is here, rather than giving generic information, because of this amendment, entities are now required to give more pointed information, specific information which applies to them as a preparer of financial statements. So what would be the possible impact of this particular amendment? Now, as we have seen that the requirement has changed, you have to give more pointed information. Therefore, entities will now need to review and clean up their existing accounting policies because they need to look at the policies which are specifically applicable to us. From an IFRS perspective, starting 1st of January 2023, starting financial reporting period, annual reporting period starting 1st January 2023, these material accounting policies only now need to be disclosed. And therefore, the entities which have so far been disclosing significant accounting policies, they need to relook at, and then I ascertain out of those, which of those policies are actually material that really need to be disclosed from the annual reporting period starting 1st January 2023. Now, let me also clarify. This 1st January 2023 annual reporting period applies from an IFRS perspective. But from an Indian perspective, from an Ind-AS 1 perspective, this requirement is from 1st of April 2023, which means for the annual reporting period ending March 2024, one need to really, the preparer who is preparing the financial statement under Ind-AS 1 also need to disclose material accounting policies. And for this purpose, materiality assessment is based on a defined term under IFRS. And we will see by way of a flow chart how one need to determine. Also, paragraph 117B of the amended Ind-AS 1 or IAS 1 provides examples of situations when the accounting policy information is likely to be material. Thereby meaning, if they are likely to be material, then in that case, the disclosure need to be given. We will detail that out in the subsequent slides. Now, the most million-dollar question is how to determine if the accounting policy is material. We have seen how the materiality or the material has been defined in the standard. But how do you actually go and apply that definition and determine if a particular accounting policy is material in your specific fact pattern? This is something which we will look at in this slide. So let's see this flow chart. This tells you how one need to determine if the accounting policy is material or not. And this particular flow chart has been significantly leveraged from the IFRS literature, which I have given the source at the bottom of the slide. So, to determine if the accounting policy is material or not, the first question one need to ask is whether the transaction, say for example, impairment of the non-financial asset. So whether the transaction itself, is it material to the entity? And how do you assess whether the transaction is material to the entity or not? You have to look at the nature, size, nature of the transaction, size of the transaction, or a combination of both. You have to look at all of these and then you have to determine whether the transaction is material or not. Now, for this also, there is a guidance which has been given in the standard. Let me go to the linked slide to tell you how do you assess whether the transaction in a particular case is material or not. So as I mentioned, the materiality assessment is company specific and is based on the nature, the size of the transaction, nature of the transaction, or a combination of both. By looking at all of these factors, one need to determine whether the transaction is material or not. Yes, if it is. Also, you got to understand that certain items, even if they are immaterial, the standard tells you that even if certain transactions are of immaterial size, they may be considered material because of the very nature. So, for example, if you are paying the compensation to the KMPs, then due to the nature of the transaction, even if quantitatively the amount which you pay to the KMPs in absolute amount terms may not be material, but by the very nature that the amount is being paid to the KMPs, it falls within the materiality definition. Also, information is considered material if the omission, misstatement, or obscuring those information can reasonably be expected to influence the decision-making process of the primary users of the financial statement. So if you have any of these situations, then the transactions, even if it is in quantitative terms, even if in absolute terms, it is not material, it will fall within the material definition. It will be material. It will be considered as material. Also, paragraph 117E of the standard, it says that disclosure requirements applicable under other standards will continue to apply only for the purpose of only for the limited purpose of determining which of the accounting policy is material or not, which warrants the disclosure in the notes. You apply these requirements. But that does not mean that the other requirements, if there are other requirements, so say for example, if there are disclosure requirements under the Ind-AS 36 or IAS 36 dealing with impairment, now those requirements will continue to apply. Those are not supplanted by the requirements of the amended IAS 1 or Ind-AS 1. Right? So those will continue to apply. Another example which is listed on the slide at the bottom, if you can see, disclosure requirement under IAS 37, which deals with provisions, contingent assets and contingent liabilities, those requirements of this disclosure under that standard will continue to apply, even if the management has determined that the accounting policy information related to provision is not material. Right? That's how you have to understand and assess whether the transaction is material or not. Going back to the flowchart. So the first question, we have to look at whether the transaction is material. How we do that? We saw the flowchart. Assume that the answer to this question is no. The transaction is not material. We have seen that. If the transaction is not material, you are not required to disclose accounting policies related to such immaterial transactions. So if the answer to this question is no, paragraph 117A and 117D tells you accounting policy information related to such immaterial transactions is not required to be disclosed. But if the answer to this first question is yes, it is material, it is not immaterial, it is material, then you got to ask another question. Question number 2 is, in that case, paragraph 117B of the amended standard guides you to ask another question. The second question would be, okay, the transaction is not material, but is the accounting policy information itself is material? How do you assess it? There is again a guidance given in the standard wherein you need to get an answer to this question, that even if the transaction is not material, whether the policy information, the accounting policy information itself is material to the financial statements. How? Let us see the circumstances, what the standard gives the guidance. In those circumstances, even if transaction is not material, the policy might be considered to be material. Let's see what the standard gives you the guidance on this. So, to get answer to question number 2, whether the accounting policy information itself is material, you have to assess these two things, which is listed on the slide. So you got to ask these two questions. Whether the user of the financial statement require the accounting policy information to better understand other information which are contained in the financial statement. If the answer to this question is yes, you need to ask one more question side by side is, okay, this information, accounting policy information, is required to better understand other information in the financial statement, and whether that accounting policy information can reasonably be expected to influence the decision-making process of the primary users of the financial statement. Collectively, it's an and condition. If the answer to this question is yes, then in that case, disclosure of such accounting policy is required. But if answer to these questions collectively is no, then you don't have to disclose the accounting policy information for such transactions. Let's continue this discussion on the next slide as well. Now for this assessment, there is the Ind-AS 1 or IAS 1 gives you some non-exhaustive list of examples. So there are 5 such examples which are given in the standard itself, wherein accounting policy information is considered or is likely to be material in these five circumstances, and these 5 circumstances are enumerated, of course, by way of a non-exhaustive list in the standard itself. So what are those 5 circumstances? So for example, if there is a change in the accounting policy during the year, so you might be aware that a new accounting standard, IFRS 17, has recently come up, wherein insurance companies now need to apply IFRS 17 and not IFRS 4 from an insurance accounting perspective. So if during the year, if the accounting policy has changed, let's say by way of adoption of a new accounting literature, then in that case, the standard reckons that this accounting policy information is likely to be material. Likewise, let us say if you have certain transactions where the accounting treatment itself is complex. So for example, you may be familiar with financial instruments accounting, right? So complex financial instruments. So for example, financial instrument with embedded derivatives. Now there are requirements under IFRS 9 or Ind-AS 109 in terms of in what circumstances you need to segregate and separate embedded derivatives from your host contract, right? So this accounting itself is complex. So in these complex circumstances, where the accounting treatment is complex, the standard says that it is likely that the accounting policy related to such transactions is likely to be material, which means you got to disclose them. The third is circumstances where significant judgment or assumptions is required in applying an accounting policy. So for example, you may be familiar, IFRS 15 has 5-step process of revenue recognition. One of the steps says you need to determine transaction price. Now, if you have a scenario where, let us say, you have a lot of variable considerations. So there, in those circumstances, determination of the transaction price, which will also include a portion of the variable consideration, can be judgmental. And therefore, what the IAS 1 amended version says that if you have significant judgment or assumptions, which is required to apply an accounting policy, then in that case, that accounting policy is likely to be considered material, which means you got to disclose them. The next bit is if you have multiple options to be chosen within the IFRS literature. So for example, if a particular policy is chosen under IFRS literature out of the alternative treatment permitted in the literature itself. So for example, cost model versus fair value model. Under IFRS, IAS 40. So for example, your investment property. Of course, this option is not there so far in the Ind-AS literature, but under IFRS world, IAS 40, you have an option to apply cost model or the fair value model, right? So if you have such kind of accounting policy choice to be made, which is permitted within the literature itself, then the standard says in those circumstances, accounting policy information is deemed or likely to be material and you got to disclose them. And the last example is given in the standard, which is the case where, let us say, an entity develops an accounting policy because for the type of a transaction which are involved in a particular company, there is no direct guidance available under IFRS. And therefore, the accounting policy for such transactions have been developed by the entity as per the hierarchy given in IAS 8 or Ind-AS 8. So for example, if a particular type of transaction is not covered in terms of the accounting treatment under IFRS, and therefore an entity uses the guidance, let us say under US GAAP, and that guidance is being used for applying in applying and recording the transaction under IFRS literature. Then in that case, the standard says that in such circumstances, those accounting policy information are likely to be material. So net, what the standard tells you that in these circumstances, it is most likely, it is possible that the accounting policy information becomes material and then you will have to disclose that. With this, now we'll go back to the flowchart. We have asked 2 questions. Let us see and complete the flowchart. How do you determine? So coming back to the slide, first question was, we have seen whether the transaction is material. If it is yes, it is material. Then the next question we just now looked at, okay, the transaction is material and whether the accounting policy information itself is material. We have seen how to assess it. If the answer to this second question is no, for example, if no, then the accounting the policy related to those transactions again are not required to be disclosed. Why so? Because they are these accounting policy information, they are not material. So the accounting policy information itself is immaterial, though the transaction is material. So if you see and relate the difference between the two boxes, the green boxes at the bottom, in the first case, left hand side, green box, accounting policy information was for immaterial transactions. Whereas in the second one, transactions are material, but the accounting policy information is something which is not material. In both the circumstances, the amended IAS 1 or Ind-AS 1 says you need not disclose accounting policy for such transactions. But if answer to question number 2 is yes, then you have to ask the third and the last question. Okay, answer to question 1 and 2 is yes. Then now you got to determine which of the accounting policy information you eventually need to disclose. That means out of the whole lot of accounting policy which you have, which of them is material and which requires disclosure to be made. For that also, there is a guidance given that how do you give an answer, how you get an answer to the third question. That also is sought to be addressed and answered by the standard. Let us see what the guidance is given in the standard. So what the standard tells you that generally it will be more useful for the users of the financial statements when entity provides accounting policy information which focuses on how you as an entity, if you see the first point on the left hand side here, how you as an entity have applied the standard in your own specific facts and circumstances, right? Also, if there are judgments which have been made by the entity, how you have made those judgments, that should be disclosed. And the accounting policy information should avoid just reproducing what is there in the standard. Rather, it should give specific insights in terms of how you have applied the policy yourself. Don't give boilerplate information which is just cut, copy, paste from the standard. Don't give this, because if you give specific information, the readers of the financial statement will have a better insight in terms of how you have actually applied the accounting policy in your particular circumstances. And that's exactly what the standard requires you to do. Also, the standard gives you some leeway that the general requirement is you should disclose material accounting policy also only. However, in some cases, if you see at the bottom orange color box, in some cases, an entity may include, I stress, may include accounting policy information which is standardized or duplicates or summarizes the requirements of the accounting standard rather than giving a specific fact pattern. Like what? Similar example which we saw in the previous slides. Let's say if you have a complex accounting standards related to, say for example, financial instruments with embedded derivatives, then in those cases, you may be allowed to give these information. But then, yes, you can give those standard disclosures, standard policy information, but if an entity discloses, very important point at the bottom when you see in this purple box, it says, if an entity discloses such immaterial accounting policies, it should disclose in such a way that you do not hide material accounting policy information. So you can give in certain circumstances immaterial accounting policy, but you should give in such a way that it does not obscure the material accounting policy information. So it should not happen that you give in such a way that the user is not able to identify which is significant or which is material, which is not material. And that's how you have to be slightly careful when you are giving these kind of information. So that's how you have to assess. So this flowchart, if you read it together, you have to ask the 3 questions, question number 1, 2, and 3. And if the answer to all of these is yes, 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 then you got to disclose material accounting policy information only. However, in certain circumstances, as we saw, even the standard policy information is allowed to be given. But then in those cases, you should make sure that you are not obscuring the material accounting policy by giving immaterial information. Also, as we have seen, an entity's conclusion that the accounting policy information is immaterial does not affect disclosure requirement in other standards. I've already told you in one of the earlier slides that this requirement is with respect to material accounting policies disclosure, and therefore if you have otherwise some disclosure requirements in other standards, those continue to apply to the entity. So this is how you will need to determine and establish which of the policies are material or not. I've just given you some illustrative disclosures from published accounts, and I've given you at the bottom, if you see, the source, it is from the latest annual report of HUL. I've given you how you can see for owned assets, how have they given the material accounting policies. Likewise, if you see for the ROU assets, your CWIP, your goodwill and other intangibles, this is just to give you a flavor to understand how the actual disclosures for material accounting policy is given, which is published in the illustrative or in the actual annual reports, which is available in public domain. Same way, let's say for impairment. And as I said, I will demonstrate. See here, if you see why and how these material accounting policy information are specific to the entity. You see at the bottom, the which are highlighted in the red box. You can see here, when they are applying the CGU and they are applying the impairment requirements, if you read at the bottom, it says the projections when you are estimating the value in use for the purpose of impairment testing. It says projections cover a period of 5 years, as the company believes this to be the most appropriate time scale over which to review and consider consider annual performance before applying a terminal value multiple to the final year cash flows. Now, if you see here, you will be able to recollect that under IAS 36 or Ind-AS 36, generally the value in use is to be computed over a 5-year period. But in certain circumstances, it is allowed to extend beyond 5 years. Now here, the company has, by way of the disclosure, they are specifically telling how have they gone about estimating VIU by considering 5-year period. Also, if you see at the bottom, it says weighted average cost of capital, WACC. How they have determined, which formula they have applied is given. Because as you know, weighted average cost of capital can be computed in multiple ways. Right? Here they have applied the CAPM, capital asset pricing model of Harry Markovich. Right? So we see risk-free return plus the market risk premium into beta. The CAPM typical model that has been used to compute the WACC for the purpose of impairment testing. So this is a clear demonstration of what I just wanted to highlight, is that the information is given in such a way that it makes more sense to the users of the financial statement, that how in the specific circumstance of the company these policies were applied. So this is what I wanted to cover for this particular video. Thank you for your attention, and I hope this was something which was useful to all of you. Since this is my first video for this particular YouTube channel, I would request all of you, whenever you are watching this particular video, please give your comments, because your comments will help me understand whether I am going in the right direction or is there anything which we need to change, okay, which makes the content useful for people who are accessing these videos. I'm sure you will be able to help both me as well as your academic enrichment of your knowledge, and I hope to bring such kind of an informative video on a go-forward basis as well. But I sincerely will request you can share this video with the people who might wanting this kind of information. Please subscribe to my channel as well if you think it is appropriate, and we'll see how does it go. This is the first video, so I do sign off now, and we will see in some other video. Thank you for your attention. Bye for now.